Try to buy fire insurance on a stranger's house and you'll be refused. It's illegal almost everywhere, because if you profit when it burns, you might get ideas. Wall Street looked at that centuries-old rule and built an exception, an instrument that lets you buy insurance on bonds you don't own, on companies you have no stake in, and in 2008, it nearly burned down the financial system itself. Meet the credit default swap. The mechanics are almost boring. A CDS is insurance on a bond. Say you hold $100 million of a company's bonds and you're nervous. You pay a dealer an annual premium, quoted as a spread. 200 basis points means $2 million a year. If the company defaults, the dealer makes you whole. If it doesn't, the premiums were the price of sleeping at night. Sensible. Useful, even. But CDS did something no insurance had done before. It unbundled the risk from the thing itself. You could buy protection on bonds you'd never owned, a pure bet that someone else fails. You could sell protection without setting aside money to pay claims, and with the risk unbundled, the bets could multiply without limit. By 2007, the CDS market's gross notional hit $62 trillion, roughly the size of the entire world economy. Stacked on top of it, invisibly, there is one genuinely beautiful thing here: the price. A CDS spread is the market's live estimate of the odds of default, a fear gauge ticking in real time. Germany trades near 20 basis points, India around 100, and Sri Lanka? Its CDS screamed past 6,000 basis points months before its 2022 default, while rating agencies were still clearing their throats. The market knew, but the fear gauge had a fatal flaw baked in. Nobody checked whether the insurer could actually pay. Enter AIG, one of the world's mightiest insurance companies. Its financial products division sold protection on $440 billion of mortgage securities. Steady premiums, top-rated bonds. What could go wrong? Crucially, it posted almost no collateral. It was collecting pennies in front of a steamroller. When housing collapsed, every counterparty demanded collateral at once. AIG was destroyed in days, and the U.S. government paid $182 billion to bail it out, because letting it fail meant every bank it had insured failed too. And it got crazier. Banks built synthetic CDOs, bundles made not of actual mortgages, but of CDS bets on mortgages. The same subprime loan could be wagered on 5-10 times over. The housing market was the casino table. Synthetics let the whole world crowd around it. Losses didn't stop at the real mortgages. They multiplied past them. Meanwhile, a few traders used naked CDS the other way, betting against the mortgage bubble. One fund famously made $15 billion watching it burn. Same instrument, both directions. After 2008, regulators finally moved: central clearing, collateral requirements, trade reporting. Europe banned naked bets on government defaults. The market shrank from 62 trillion to around 10. Here's the honest verdict, though. CDS didn't cause 2008. Reckless mortgages did. CDS amplified it, concentrated it, and hid it until it was everywhere. The instrument survives today, mostly tamed, doing its two real jobs: insurance for lenders and an early warning siren for everyone else. So hold the lesson. A derivative is just a promise. And 2008 is what happens when the world discovers all at once that the promiser can't pay. If this made the crisis finally click, there's more where that came from.